All right, let's just jump right in. Today, we're going to talk about a totally different way to look at the markets. And it's a way of thinking that, well, it's not about trying to hit home runs and make the biggest profit possible. Nope. It's about one thing and one thing only: survival. And to even start talking about that, we've got to ask a really basic question. Just think about it for a second. When I say the word capital, what's the first image that comes to mind? I'm guessing for most of you, the answer is just money, right? But see, that's only a tiny part of the picture. The real answer, the one that actually determines if you're going to be successful long term, it's endurance. Capital is your staying power. It's your ability to keep playing the game. Because look, the market doesn't care who's the smartest person in the room. It only rewards the people who survive. If you go to zero, it's game over. That's it. Full stop. So why am I harping on this survival thing so much? Why is it such a big deal? Well, it all comes down to some really simple, but man, it's unforgiving math. The thing you have to get is that gains and losses, they don't work the same way. It's not symmetrical. And if you don't get this, you are just not going to last. Okay, let's make this super clear. Imagine your account takes a huge hit. Let's say it drops by 50%. Oof, that hurts, right? So now for the million-dollar question. What kind of gain do you need to make just to get back to even? Now, your first instinct is probably to say, well, 50%, right? Wrong. The brutal, cold, hard math says you need a 100% gain. You have to literally double your money just to get back to where you started. And that right there, that's why the climb back up is always, always so much harder than the fall. And listen, this isn't just some clever saying. It's a real, formal mathematical thing called the gambler's ruin problem. And what it proves is kind of terrifying. You can have an amazing winning strategy and still go completely broke if you push it too hard. Your number one job before anything else is to keep that risk of ruin as close to zero as you possibly can. You know who understood this better than almost anyone? Warren Buffett. His famous quote, "Rule number one, never lose money. Rule number two, never forget rule number one." That's not just a cute line. It is the absolute foundation of a philosophy that gets the brutal math we just talked about. It's all about one thing: preserving your capital. Okay, so if avoiding these huge losses is so important, you'd think the models that all of finance is built on would be designed for that, right? Heh, well, you'd be wrong. And that brings us to a huge problem. The entire foundation of modern finance, it's built on an idea that's powerful, for sure, but also deeply, fundamentally flawed. And here it is. This is the theory. The nice, neat, beautiful bell curve. And what it tells us is that, most market moves are small and predictable. And those huge, crazy events, the massive crashes, the epic rallies, the model says they're so rare they might as well be impossible. It's a really comforting story. The only problem? It's just a story. It's not real. Because this is reality. That tiny little bar on the left, that's what the theory says should happen when it comes to extreme moves. And that giant bar next to it, that's what actually happens in the real world. So these models, they're not just off by a little bit. They're catastrophically wrong. The things that the model says are impossible happen all the time. We call these fat tails for a reason. And if you want to see just how ridiculous this gets, just look at these numbers. Back in the '07 crisis, the CFO of Goldman Sachs said they were seeing 25 sigma events multiple days in a row. Now, according to their models, a 25 sigma event is something that should only happen once in, well, it's a 1 followed by more zeros than there are atoms in the known universe. I mean, come on, the model isn't just wrong, it has absolutely no connection to the real world. But believe it or not, the rabbit hole goes even deeper than that. This whole fat tails problem, it's really just a symptom of an even bigger, more fundamental error in the way we're taught to think. It's something called the ergodicity error. So here's the key thing to understand. There are actually two different ways to think about an average. The first is what academics use. It's called the ensemble average. Think of it like a million different people placing one bet each, all at the same time. But that's not how life works for you, is it? You live in the time average. You're one person making a series of bets, one after the other through time. And here's the scary part. The results of those two averages can be wildly dangerously different. Let's make this real with a little game, okay? Imagine we flip a coin. If it's heads, you gain 50% on your money. If it's tails, you lose 40%. Now, if you show this to an economist, they'll tell you to take that bet all day long. They'll say the ensemble average gives you a positive 5% return. But what happens when you play that game over and over and over again? Well, your time average is actually negative 5%. You will almost certainly go broke. The theory says you get rich, but reality says you lose everything. So, okay, we've established the market is not some neat, tidy bell curve. And we know that the way we think about averages can be super misleading. But all those external problems, that's only half the battle. The other, maybe even harder half, it's fighting the enemy looking back at you in the mirror. It's our own brains. You know, our brains are hardwired with these, let's call them glitches, that are just awful for investing. There's overconfidence, thinking we're smarter than everyone else. There's that classic fear of missing out, or FOMO. But the big one, the real monster, is loss aversion. Psychologists have shown that for most of us, the pain of losing $100 feels about twice as bad as the pleasure of gaining $100. And that one simple fact, it explains so many of the crazy, irrational things we do with our money. And get this, it's not just in your head anymore. Modern technology, especially trading apps, are literally designed to prey on these psychological weaknesses. I mean, the SEC itself wrote a memo saying that these apps are gamified. They use digital confetti when you make a trade, constant push notifications. All of it is designed to trigger that FOMO and make investing feel less like a serious, calculated activity and more like you're playing Candy Crush or pulling the lever on a slot machine. And that brings up a really important question. How are all these free trading apps making money? Well, the answer is something called payment for order flow. See, your broker isn't making money when you make money. They're making money by selling your trade orders to giant, high-frequency trading firms. So think about what that means. Their entire business model depends on you trading as often as possible, not as profitably as possible. It's a huge conflict of interest. They need your activity, not your success. All right, so we've got flawed models, we've got our own brains working against us, and we've got technology designed to make us trade more. So, what do we do? Where does that leave us? It means we have to throw out the old playbook. We need to adopt a whole new framework, this survival mindset, and learn to read what the market is actually doing, not what some outdated textbook says it's supposed to do. And a really powerful tool for this is a mental model called the composite operator. Now, this isn't some conspiracy theory about a secret group controlling the world. It's just a way of thinking. Instead of seeing the market as a million random people doing random things, you view it as if it were being directed by one single intelligent player, the smart money. The goal isn't to beat them, it's to figure out what they're doing and ride their coattails. So how do you see what this composite operator is up to? You have to look under the hood at the market's engine, and that's something called order flow. It's all about watching for big imbalances. For example, when you see aggressive buyers just gobbling up every single sell order at a certain price level, that's a phenomenon called absorption, and it's a huge clue that buying pressure is building up. The flip side of that is exhaustion. By watching this, you're not guessing anymore. You're literally watching the battle between buyers and sellers play out in real time. At the end of the day, this all comes down to a massive shift in how you see the market. You have to stop just reacting to the little wiggles on a price chart. You have to start looking deeper and understanding the actual forces, the raw supply and demand that are causing those wiggles in the first place. And that brings us full circle, right back to where we started. Look, anybody can look like a genius when the market is going straight up. The real test, the only test that matters, is whether your strategy can survive when things get ugly. So I'll leave you with this one question to think about. Is your strategy designed to win one little battle, or is it built to survive the entire long war? Because when it's all said and done, survival is the only thing that counts.